Nicholas Stamenkovic is fixed income strategist at RIA Capital Markets, joins us live now from Edinburgh. So what is the feeling, what is the sentiment right now in the bond markets? How do you characterise that?
Well, I'd say most people in the bond markets are not expecting a substantive from Mr Bernanke today. They're expected to outline the rationale for the change in the statement from the FOMC after its latest meeting, and to outline some of the options that the Fed could use if the economy surprises to the downside going forward. But I doubt he's going to signal anything imminent today.
I mean, if we look at what the Treasury markets are telling us right now, short-term borrowing costs, even long-term borrowing costs, exceptionally low, even in the aftermath of a downgrade. How do you read into that, and what does that suggest to you about the need for more stimulus?
Well, the front end of the curve has clearly been boosted by the statement we saw by the Fed at its last meeting, signalling that rates will remain conditionally on hold for at least another 2 years. We've seen 2 years move to record lows on that. The longer it's been driven by worries about the US economy, the downgrading of growth expectations, and also expectations that the Fed could possibly announce some further stimulus further down the road. On top of that, we've seen renewed risk aversion with equity markets under pressure, credit spreads widening, and funding stress evident, particularly in European banks. As a consequence of that, we've seen long-term Treasury yields fall quite sharply.
Well, tell me then, there seems to have been some anticipation. There's been mixed feelings about it, but nevertheless, the anticipation has definitely been there that we could see some form of stimulus. If we don't get anything concrete from Bernanke, could that lead to an increase in yields?
I think it very much depends how equity markets react. There's been a very strong correlation recently between risk markets and government bond markets, and if there's disappointment that the Fed is not going to do anything anytime soon to give a boost to the US economy, then the recent rally we've seen, or recovery on US equities, would run out of steam, and we'd see a renewed flight to quality US Treasuries. I think that's the most likely outcome, and indeed there's opposition amongst the Fed to the latest FOMC statement and the commitment to an unchanged interest rate policy at least in the next 2 years. So I think the likelihood is that Bernanke will sit in his hands for now, assess the outlook for the US economy, and if things deteriorate, then he may announce further policy options down the road, but I doubt he's going to pursue QE3.
We spoke to Eric Pellicicaro, who's head of global rates at investment at New York-based BlackRock, and he said that 10-year Treasury notes right now, great buying opportunity at yields of about 2.5% as growth slows. What do you make of that?
Well, I think the market's already discounted a pretty gloomy economic outlook. If you look at real yields up to 10-year sector, they're already negative, suggesting the market is pretty pessimistic about the outlook for the US economy. So we need to see renewed signs of weakness, or further signs of weakness, from the ISM manufacturing survey next week and the next employment report. Clearly, if the US economy does dip back into recession, then 10-year yields could move back below 2%. But my view is the economy will just around skate above recession. We'll see a prolonged period of weak growth, but I think on a 3 to 6 month horizon, Treasury yields will be somewhat higher than they are at this juncture.
How much higher?
Well, we're currently trading around 220, 225% on the 10-year. I think in a 3 to 6 month horizon, we could be at 250, maybe even 3%. I think the market's too pessimistic about the US economy, and I think that we'll start to see a renewed, some improvement in risk appetite going forward, and hence the flight to quality unwind and Treasury yields will rise further.
That's interesting. Given the turbulence that we've seen in the markets over the past few weeks, what would be the catalyst for a rise in borrowing costs and a boost in risk appetite?
Well, we'd obviously have to see better signs of the US economy. Obviously, as I said, we've got 2 key data releases coming in next week. Clearly, if they disappoint, then we could see yields temporarily go lower. But I think there are some signs of support for the US economy. Oil prices coming down. Companies still have a lot of cash, and I don't think there's scope for a large rationalisation or corporate restructuring to take place in the US economy. And I think if we do see any sort of improvement in Europe, which doesn't seem likely at the moment, then a combination of those factors could push yields moderately higher over the next 3 to 6 months. So I don't recommend buying government bonds at these levels.
OK, and also, Nicholas, what are you expecting with the dollar if we don't see any immediate further stimulus, but perhaps if Bernanke signals that he is ready to act if conditions deteriorate? What does that mean for the dollar? Could we see a bit of a bounce?
Yeah, the dollar's bounced because of its safe haven status, but I think there's a lot of nervousness about the fiscal position in the US. They've only started to tackle the surface, And if they announce QE3, then I think the markets will worry about that could generate inflation pressures over the medium term and be another negative for the dollar. So over the medium term, I'm bearish towards the dollar, but near term, it should get some good support.
Good to talk to you. Thanks so much. Nicholas Stamenkovic, strategist, fixed income, RIA Capital Markets. Appreciate your time.